Welcome to the deep dive. We're looking at a really foundational shift happening right now in the world of large parcel merchandise, specifically furniture.
Right.
And this isn't just a small tweak. We're talking about a move that could define who owns the customer experience for the next, decade.
Exactly. I mean, we are witnessing what feels like a critical inflection point. It's a race for scale, and GigaCloud Technology is making a very bold, very strategic move.
Okay, so let's unpack that.
This whole deep dive is about understanding how one very targeted acquisition is set to reshape the entire commercial furniture landscape.
And that acquisition is GigaCloud buying new Classic Home Furnishings. It officially closed, January 2nd, 2026?
That's the one.
So the mission for you listening is to walk away understanding not just the nuts and bolts of the deal, but the bigger strategy here, the one that makes GigaCloud such a huge player in this whole consolidation game.
Let's start with the basics then, the numbers. Because the financial discipline here it's pretty remarkable. GigaCloud paid a total of $18 million for 100% of new Classic.
$18 million.
And critically, it was on a debt-free basis. They bought the asset clean, no liabilities attached.
And the funding story, I think that's maybe the most telling part.
Oh, yeah.
They didn't need to go out and borrow. The entire $18 million came right from GigaCloud's existing cash on hand.
Which just shows you how strong their balance sheet really is.
I mean, they were sitting on, $367 million in total liquidity as of Q3 25?
Right. So for them, $18 million it's a very targeted, almost low-risk expenditure.
A tactical deployment of capital.
A very tactical deployment. And what's fascinating is they haven't just bought a company. They've sort of got an incentive program.
What do you mean by that?
The deal includes a post-close earnout. So a portion of that money is actually held back until new Classic hits very specific revenue milestones through 2026.
Oh, interesting. So it aligns everyone's incentives.
It aligns them perfectly. GigaCloud is paying for performance, not just potential.
So who is this company, New Classic?
They're a profitable 25-year-old U.S. furniture distributor. They do about $70 million a year in revenue.
And they serve a huge network. Over 1,000 retailers, right?
Over 1,000. But here's the twist. The key part. That customer base is almost entirely brick and mortar.
Physical stores.
Exactly. And that fact, those deep roots in physical wholesale, that is the strategic nugget right there. This deal isn't just adding capacity.
It's filling a huge structural gap for GigaCloud.
A massive one. But to really get why this matters so much, you have to look at their history. They have a playbook for this.
Right. This is where it gets really interesting. This isn't just opportunistic shopping for them, is it?
No. M&A is a core part of their growth engine. And the best example, the proof point, is what they did with the Noble House.
The Noble House story is like a legend in this sector.
It really is. I mean, think about it. Noble House was bankrupt, totally bankrupt. They were losing nearly $40 million back in 2023.
$40 million? That's a massive hemorrhage.
It's a disaster. But GigaCloud bought them anyway because they believed they could fix the fundamental plumbing.
And they actually did it. How? I mean, what was the actual mechanism?
It wasn't magic. It was just technology and logistics applied ruthlessly. Noble House had the products, but they were managed so inefficiently.
Okay.
So GigaCloud just plugged their entire catalog into its own B2B platform. They use their AI tools to optimize inventory, slash warehousing costs, get rid of dead stock.
And streamline that really expensive last mile freight.
Exactly. So you combine the distressed company's product depth with GigaCloud's operational brain, and you turn a $40 million loser into a profitable, growing asset.
In less than 2 years.
In less than 2 years.
Imagine the confidence that gives you, if you can turn around a sinking ship like that.
Then accelerating a healthy $70 million company like New Classic must seem pretty straightforward.
But this M&A drive, it's not just a GigaCloud thing, is it? The whole sector is doing this.
Absolutely not. This is part of a much bigger, much faster wave of consolidation across the entire furniture space. It's an industry-wide scramble for scale.
I mean, the biggest data point was that massive H&I Corporation deal to buy Steelcase. Right? Back in August of 25.
That was a monster deal. $2.2 billion.
Even bigger than the Miller-Knoll deal, which was $1.8 billion.
Right. And that's critical context. Now, H&I and Steelcase were focused more on office furniture, and GigaCloud is more home goods, but the underlying reasons are identical.
And what are those reasons? Why is everyone suddenly so desperate for scale?
Well, there are three, I think, non-negotiable forces at play. First, you need scale to fight margin compression. Inflation on materials and labor isn't going away, so you have to get bigger to get cheaper.
Makes sense.
Second, you are desperate for supply chain diversification. You can't have all your eggs in one basket anymore. And third, you have to adapt to new demand.
Like the whole hybrid work situation.
Exactly. That requires much more agile distribution. So if you don't have scale and you don't have diversification, you are structurally vulnerable.
Which brings us right back to New Classic. GigaCloud called it a perfect strategic fit.
They did.
But, GigaCloud is this tech-forward e-commerce giant. New Classic is all tradition and brick and mortar. Is that really a perfect fit? Or is it them just plugging a hole?
Well, that's the essential tension, isn't it? GigaCloud has been brilliant in the e-commerce world, serving digital retailers. But the physical retail world?
The showroom model?
Yeah, that whole model is enormous, and it requires totally different expertise, different products, different logistics. This acquisition is their deliberate move to bridge that divide.
So the goal is to become platform agnostic.
Precisely. They want to create a, quote, truly channel-agnostic B2B marketplace.
Imagine the reach that gives them.
It's huge. Whether your customer is a regional furniture chain or a dropship website, you can serve them both seamlessly. You take New Classic's 1,000-plus physical retailers and pair them with GigaCloud's logistics.
And suddenly you can service both sides of the market. That flexibility is the real competitive moat.
That's the moat.
Okay, let's talk about the supply chain. You said it was non-negotiable, especially now. This seems like the most immediate, tangible value that New Classic brings.
It is. What's so fascinating is New Classic's sourcing profile. It immediately solves GigaCloud's geographical concentration risk.
How so?
Less than 3% of New Classic's product comes from China.
Wow. Only 3%.
Think about that. The vast majority is sourced from Southeast Asia and the United States.
So that immediately takes a huge headache off the table.
A massive one.
All the tariffs, the geopolitical stuff with China that everyone's been dealing with.
All of that, the disruptions, the friction, it just becomes much less of a problem for them overnight. It's more than just risk mitigation. It's an optimization play. Reliability wins contracts in B2B.
So beyond the big strategy, what about the day one operational benefits? What does New Classic actually hand over?
Two crucial things. First, that deep expertise in physical retail, which GigaCloud just didn't have. Second, they bring over 2,000 active SKUs that are already popular in that marketplace.
And GigaCloud's job is to just plug those assets into their tech platform.
Exactly. And we already know what that platform can do from the Noble House story.
Right.
They can use their AI for better inventory management, faster credit risk assessment for new partners, and they can streamline the entire distribution network. It's about weaponizing New Classic's physical assets with GigaCloud's digital brain.
When the deal was announced, the market reaction was kind of muted, right? Small positive bump.
It was modest, yeah.
Yeah.
A 1.85% bump. I think the market sees the strategic value, but also respects the integration is hard.
And management isn't overpromising.
No, they're being very realistic. They said themselves that it'll take 4 to 6 quarters, so a year to a year and a half before the full financial benefits really show up in their performance.
So this is a long-term play for them.
A very structured long-term strategic integration. They believe it'll pay off big by 2027.
So if we pull back this whole landscape, this consolidation, this scramble for efficiency,
Yeah.
what does it mean for investors trying to pick the winners and losers?
Well, it raises the single most important question, I think. In a sector where scale and tech are creating bigger and bigger gaps between companies, who is positioned to win?
And who is structurally unable to keep up?
Exactly.
Which I think takes us to our final segment.
It does. But before we go there, the crucial reminder, the following is for educational and entertainment purposes only. This is absolutely not financial advice. Please do not try this at home.
Okay, so with that out of the way,
Yeah.
our deep dive into these dynamics, this widening gap between the tech-savvy consolidators and the legacy guys, it suggests a very specific pairs trade.
The whole idea is to capitalize on that divergence. We're betting on the acceleration of that competitive differentiation.
The trade is built on the belief that GigaCloud's platform is going to actively eat the market share and pricing power of its less advanced peers.
It's almost inevitable.
So, action one. You initiate a long position in GigaCloud, ticker GCT. You're betting on their playbook, their balance sheet, and their creation of this channel-agnostic platform.
Yeah.
They have all the momentum.
Okay, and for every long, you need a short. So, action 2. You simultaneously open a short position against a competitor who is structurally vulnerable to all this pressure.
And we are looking specifically at Hooker Furnishings.
Hooker Furnishings. Why them?
Well, the data shows they are fighting a losing battle. Let's just break it down. Their last 12-month revenue, looking at a 3-year compound annual growth rate, it's negative 12.8%.
Okay, let's translate that. A negative 12.8% CAGR means they have been shrinking consistently for years.
It's deep structural contraction. They aren't just flat, they are losing revenue fast.
And then there's the balance sheet.
The most damning part, their leverage, their debt to EBITDA
Right.
and net debt to EBITDA ratios are just astronomical. 16.6 and 15.3 times respectively.
When you see leverage ratios that high, it means you're borrowing $16 for every single dollar of operating profit you make.
How do you even compete?
You can't. You can't compete on price. You can't compete on speed. You can't invest in new tech.
Yeah.
So when the new GCT new Classic machine starts driving prices down, a company like Hooker is the first to get crushed.
So the pairs trade is a bet on structural change versus legacy inertia. You're long the tech-enabled future.
And you're short the over-leveraged past. That gap is only going to widen as GigaCloud digests new Classic over the next couple of years. It's not a matter of if they'll erode market share, but just how fast.
It's a fantastic deep dive. We've covered GigaCloud's strategic channel expansion, the smart, low-risk deal structure, and that critical supply chain resilience they just bought.
And the central theme holds. The future of this sector will be defined by massive scale, tech-driven leverage, and true channel diversification.
If you're not integrating and optimizing.
You are making yourself a target for the next wave.
Fascinating stuff. We hope this gave you the essential context you needed to stay informed. Thanks for joining us for this deep dive. We'll be back soon with more analysis.